Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy.
Gary Wagner is back. He is the editor of thegoldforecast.com and will be breaking down what happened today at the Jackson Hole Symposium. Welcome back to the show. Good to host you as always, Gary.
Thanks for having me. It's great to be here.
We're speaking right now as of 5 p.m. Eastern time. It seems the markets have been rather muted in response to what Jerome Powell has said. So let's just break down what he said. A number of key points that he's mentioned. The first is that
although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective.
Now, Gary, as soon as he said that, the CME Fed Watch tool saw a spike in the probability of a rate hike by the end of the year. Previously, it was overwhelmingly in the favor of no hike. So does this signal to you that a hike may come? Another one?
Well, it could. There still is a overwhelmingly high probability that the next meeting will contain a pause, no rate hike. The one thing that really stuck out in terms of what Powell said today was that we're navigating using the stars in cloudy markets. Now, if you take that sentence apart, you have to realize that you can't navigate the stars by using the stars if there's clouds above. So was he saying that we just don't know or we can't do it? He was excellent at threading the needle as always. He covered good ground in terms of their process, but didn't provide any concrete timeline.
I guess it's now a race between inflation and the end of the year because you're right. There's an overwhelming probability of no hike by September, but a 40-something% chance of one hike by December. I suppose if inflation were to dramatically go down towards 2% by December, potentially they'd hike. Do you see that happening? Is that possible? Potentially they would stop hiking. That's what I meant to say.
Yeah, I mean, obviously no one knows. I think that although Powell came off with a hawkish speech, the undertone to me is that they don't want to have to raise rates and they do want to implement a pause, but the data will support whether or not they have to. And I like that component of Powell's address. It certainly wasn't the fire and brimstone that we got last year, where he said, get ready, the American public and the citizens are going to feel pain. And that was a shock and awe moment last year. I think that this year his speech was well received because market participants were aware of what he might say, and the expectations were met in that way. Also, the expectations that he wasn't going to be concrete in terms of a timeline and addressing the specific 2 points that people want to know, whether or not we're going to get a rate hike this year. And then most importantly, when will they begin quantitative easing and pivot the monetary policy from extremely restrictive to accommodative? He didn't really have any timeline except that interest rates might remain high for a long period.
Well, he also did say that...
Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions.
When he says restrictive policy, does he mean more hikes, or does he just mean keeping rates where they are and not cutting anytime soon?
I think that both. He's leaving the door open for more hikes if necessary. In other words, if the data shows that inflation ticks up unexpectedly and veers from the current path that it's on, which is lower, and the Fed, I believe, is quite satisfied, considering that they started with a level when they first raised rates in March of 22 of over 8% in terms of core inflation, 9.1 headline inflation, and now they're down to 3.3 in terms of what they're looking at in terms of inflation. They've come a long way. He acknowledged that, but he also cautioned or softened that statement by saying that it depends on the path forward, and that depends on the data.
Now, he has admitted in a speech that there's been a tightening of financial conditions and a tightening of bank lending as well, which, in his words, typically contributes to a slowing in the growth of economic activity. However, he says,
we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend. And recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy.
Yeah, he's right. Advanced retail sales are strong. If you look at the Atlanta Fed, for example, the GDP now, the Atlanta Fed, Gary, is projecting a growth in real GDP of 5.9% by Q3. That is a huge jump from current levels. Do you agree with this optimism?
One of the comments by a Federal Reserve official after his speech was that there is no historical data in which the Fed has been so restrictive, and they've raised rates 11 times since they began the pivot, and at the same time had economic strength and growth in the way they have. If you look at any other moment in which the Fed attempted to tackle inflationary pressures, it had a profound impact on contracting the economy, which of course is their end goal. Here, they've raised rates 11 times, and at the same time, the economy is robust. It's running on 9 out of 8 cylinders. The 5.9% GDP is really updated from the last time I looked at the data, and that's about a week ago, in which they were forecasting 5% GDP. So look at how it has gotten even more robust in terms of their predictions in a week to 2 weeks. So absolutely, this is a unique period in which the Federal Reserve's been extremely restrictive. They have raised rates 11 times, taken it from between 0 and 0.25% up over 5%, and yet economic growth continues. The labor market is still hot. It's bewildering, and that's according to a statement of another Federal Reserve official. He said, we're bewildered by how the economy's still we're seeing so much growth in the economy with the steps that we have taken. And I would have to agree with that, because economic growth is prevalent and interest rates are five points higher than they were from the pivot.
Well, what would make them pivot? What would make the Fed cut rates, specifically cut rates?
Well, that's an easy question. If the Fed believes and sees data supporting that they're either at or close to or on a strong path to 2%, they will first pause and then cut. It's going to be supported by the resolve that they have to take inflationary pressures down to 2%. If they see that either they've reached that goal or that the path is kind of not etched in stone, but it would take a tremendous shift in inflation moving up rather than down for the Fed to begin to cut rates. And they're looking at the data. And that's what he's made clear more than anything else. The data will support their decisions.
This next question, obviously nobody knows because neither of us work in the Fed, but once inflation goes down to 2%, do you think the Fed would want to cut rates? Meaning they have two options of either keeping course, which is to stay elevated with their rates, or they can reduce their rates and cut rates. Maybe 5% is the new normal, is what some people have wondered. We're never going to see a lower rate again. What do you think?
Again, we don't know. What I do believe is if they hit their target, what I used to look at in terms of technical analysis when I charted a market that was in a defined uptrend, before it reversed and went into a corrective period, it had to do what? Stop. In other words, if a market's in an uptrend, before it moves into a downtrend, it settles, it stops, and then it reverses. In the same way, I think that the Federal Reserve will continue to be on their current path until the data supports their closing in on 2%. At that point, they're going to pause first. Now, how long they pause and what the timeline is for the beginning of rate cuts, and we're hoping it's second quarter, first quarter of next year, will depend on whether or not they get closer to their target. And they're not that far off when they're at 3.3% and the target is 2.
Right. Now let's look at the US dollar. It's also been performing very well over the last month, up about 2.8%, the DXY I'm looking at. What has the dollar been responding to?
The economy and the growth of economic growth in the US compared to the Eurozone and the yen and the basket of currencies it trades against. Dollar strength has been prevalent for at least a month to a month and a half. After trading to a low of about 99 on the index, it's now breaking above 103. It's flirted with 104. I see dollar strength continuing based upon the fact that the economy in the US is strong and it's robust compared to other economies right now. When you look at China, they're having definitive issues in terms of growth and their GDP, although I think that that's a short-term issue right now. And in Europe, when we compare GDP of the Eurozone to the US, the United States is really, it's running on 8 out of 8 cylinders.
Gold is an interesting market. So are you surprised that gold has held up as well as it has, meaning it hasn't fallen even more despite a rising dollar, despite rising bond yields, and despite lower inflation? I mean, gold has fallen from 2000, but it's still hovering around $1,900, which is not too far from its highs.
Absolutely. And that's a great point. Gold has excellent technical support at 1900. We witnessed that in the past couple of months, and just in the last couple of weeks, we saw really a strong level of support move from about 1900 to about 1915. And even with today's volatility, the low was $1,931. I am looking at future pricing, not spot pricing. But we saw the market in terms of gold prices exceedingly volatile. Stocks recovered, gold recovered. So there was an initial shock as he spoke and then a calmness afterwards. I think that as long as the Federal Reserve is doing a monetary tightening or is in their monetary tightening process, we will see dollar strength continue based on economic growth rather than the rise in interest rates. And your point's excellent. Financial markets overall have been extremely resilient considering the amount of rate hikes and moving from 0 to 5 over 5%. And that is because there's economic growth in the US. We're not getting the typical recessionary process that would be an outcome of Federal Reserve monetary tightening.
Yeah. Okay. Just by the way, before we move on to talk about gold technicals, what you just described, the economy growing, has that surprised you this year, given how a lot of people were calling for a recession last year?
I would say it has impressed me more than surprised me. Coming out of the recession, there was so much pent up demand. That was as Powell addressed during the speech, it was at the end of the pandemic and the pent up demand and the supply chain issues that initially caused inflation to begin to spiral upwards. That has worked itself out of the system, and the tightening by the Fed has definitely lowered inflationary pressures. And as such, I am impressed by the resilience. I'm not surprised so much because there was so much demand a couple of years back that fulfilling that demand is going to A, raise prices on goods and services, and then B, cause inflationary pressures as a direct result of the pent up demand working its way through the system.
Yeah, well, certainly it surprised a lot of people. So we'll keep tabs on how the economy progresses. Final question on the economy, and we'll end on gold. If you were the Federal Reserve, which data would you have to look at definitively to say to you, we are in a recession, it's time to change our stance?
Well, the definition of a recession is a contraction of real GDP for 2 quarters in a row. And as you just quoted, the Atlanta Fed is looking for really robust GDP numbers going forward. And that's the opposite of a recession. In other words, that part surprises me more than anything else. The fact that we had a fairly smooth recovery and there was really strong GDP growth is, I believe, the beginning or the net result of the fact that there was pent up demand. But the economy running so smoothly in terms of that rekindling and buildup, that is impressive. And I think the Fed has acted properly in raising rates. I think they will continue to guard what their future steps are in terms of a timeline, but they did address what they're looking to achieve and the resolve that they have in reaching that goal. That's what I got out of today's speech by Chairman Powell.
Okay. Now, turning to gold technicals, if you were to look at the price of gold on a year-to-date basis, it is still up. The gold price has had a tremendous rally in March, as you know, but ever since its peak around May, it's been reaching lower highs ever since. So, would you characterize this as a short-term correction from its highs before a rebound, or are we entering a new bear market for gold? What's going on?
Well, whenever a market, specifically when gold came very, very close to its all-time record high, and that's what you're looking at in terms of the highs this year, it really has nowhere to go but down unless it's going to make a new record high. And I don't think that that was in the stars or in the cards, so to speak. So that once it hit that hard ceiling, it is not that unlikely to see it correct or move lower from that point. It's where it will find support. And the short-term answer to that is around 1900. We've seen it find support and bounce back up. What I'm wondering is, will it make a stab for those all-time record highs or not? And I think that that will be difficult. But I do think that there's still growth to the upside, but the hard ceiling is probably around $2,000 rather than the record high, which is 2,085, this year 2,083 in terms of the highs of futures pricing in gold.
Mm-hmm. So let's break down the variables that gold responds to then. I guess inflation, the US dollar, and real interest rates. Putting together everything we've discussed so far with the Fed and the economy, what needs to happen to these macro variables in order for us to see gold retrace $2,000 and perhaps go even higher and beyond?
More uncertainty as to whether or not the Fed's target is, whether or not the Federal Reserve is getting closer to their target of 2% or moving away from it. That's going to be the key, is obviously inflation. Gold tends to move up during periods of high inflation, and we're seeing it decline and gold remain steady, which means that market participants are actively looking to buy the dip. And that's what we've seen more than anything else. Is it warranted for it to have this much strength? In other circumstances, everything being equal, we might not have seen this kind of strength, especially with recent strength in the dollar. It's been literally on fire, as you said, up but over 2% in the short term. And gold has managed to maintain a price point above 1900. So it has been impressive, to say the least.
I know you're a student of waves, the Elliott wave theory. And if we were to zoom out and look at gold from a multi-year basis, Gary. I wonder if it's been following some sort of pattern that perhaps can be described by the waves. I'm just looking at it from let's say a 12-year basis. Ever since its highs in 2011, it's come down to around $1,100, and it's consolidated around that range for a number of years before finally breaking out to the range that we're seeing now. But ever since 2020, gold has been more or less range bound between as low as 1640, 1630 to the current levels. Hasn't broken much below, hasn't broken up much higher. Is this part of a bigger cycle, Gary, is my question?
I believe it is. I think that if you look at the super cycle in gold, and that's that long-term view over 12 or 15 years, I think that in terms of an Elliott wave count, what we've been witnessing since hitting the highs at about 2080 has been an ABC correction. Once that concludes, all things being equal, according to Elliott wave theory, the bullish trend will return if the same variables that moved gold higher in the first place are still in play. And so I definitely believe that we have been witnessing the end of a bullish momentum move, meaning the 5 count up, and this recent decline is part of an ABC correction.
Okay. Short-term targets again for gold?
Support definitely at $1,900 to $1,915. First level of resistance comes in around $1,980 up to $2,000. And in terms of that range itself, we could see gold becoming range bound, having a base at just above 1,900 and a ceiling just below 2,000.
Well, Gary, thank you very much. Where can we follow your work and understand a little bit more about technical analysis?
Thanks for asking. Thegoldforecast.com is my primary website. We do have a huge library on our YouTube channel of about 2,000 videos over, now it's since 2009, so a long time. And that would be the best ways for those interested in my work and what I'm looking at, as well as my forecast for gold throughout this year will be best served by looking at our YouTube channel.
Okay, we'll put those links down in the description below. Appreciate your time as always, Gary. Thank you for coming back, and we'll speak again next time. Thank you.
Thank you so much for having me.
And thank you for watching. Don't forget to subscribe.